Trump's inauguration, volatility has picked up, and we've got Jim Welsh with Macro Tides to break down all this volatility and some of the economic data that's coming in behind us. So, Jim, how are you doing? Happy Friday.
Happy Friday. Some Fridays are more happy than others.
Yeah, that's for sure. Well, I mean, you can't really be too unhappy with you've got the stock market at all-time highs. Once again, doesn't look like that's gonna abate. So happy days are here to stay, right?
We'll see. I think one of the tests that will come, because one of the things that the stock market liked is that President Trump didn't on day one say, okay, I'm slapping Canada and Mexico with 25% tariffs. I'm going to hit up EU, and of course, we're going to slam dunk China. And I think that helped a lot, in terms of, well, okay, maybe it'll be a more moderate approach. And I think the market responded to that. What he has indicated is he didn't say for certain on February 1st, but around, I think he said, well, around maybe February 1st, where, okay, they're going to announce. So what he did create is a window, a space of time where, all right, we can talk to Canada and Mexico and the EU before this date, whether it's February 1st or shortly thereafter, he's going to announce something. So I think, again, that's the hurdle that the market will have to face in the first part of February, because they're going to, I'm assuming, make an announcement that we're going to do such and such. And some of these countries, and we've already seen a little bit of it from Canada, well, we ship you 4 or 5 million barrels of oil a day, and it's a heavy stuff that the Midwest refiners can use. So maybe we'll cut those off. So, I mean, the positioning beforehand where both sides have to kind of raise the bar in terms of Trump saying, well, this is what we want, and the other countries responding, well, this is what we'll do if you want to go through with that. And, it's all setting up the negotiation. But my assumption here, Blake, again, is that there's going to be bumps as the negotiations go along. And I'm assuming that that's going to lead to some, additional volatility in markets as they start to, oh, what? In other words, at some point in time, if the back and forth becomes intense enough, the question of, oh man, maybe this is going to lead to a trade war. If that starts to come into the conversation, I think, the equity market's going to pull back.
But how about if it doesn't, Jim? I mean, last night, for example, you had an interview with Donald Trump, and he said, "Look, I talked to President Xi, and out of China, I'd rather not impose tariffs on China."
Right.
I mean,
Right.
look, they're talking. They talked actually even before the inauguration. How about if things go good? Then what
Yeah.
happens?
Yeah.
What happens there?
Well, it'd be positive. Obviously, anything short of a trade war is a positive. If they go relatively smoothly, I think on balance, that's a positive. But again, I'm not sure that there won't be some inflationary aspects. I mean, already we're seeing people buy stuff in anticipation of tariffs. And so in the short run, is that goosing economic activity? Yes. Is it a bad thing? Not necessarily. So I just would be surprised, Blake, if everything goes completely copacetic, not a single speed bump. I just think there's going to be give and take, because there's going to think. So for Trump, again, it's all a negotiation. I'm going to say 25%, but 5% would be okay as long as I get these things. And for the other people, it's like, okay, if it's only 5%, we're willing to give some of these things, but we're going to want one or two things ourselves. It's just going to take a while for that to all play out. And, again, my assumption is that there will be bumps in the road. These are big time negotiations. I mean, basically, one of the things he wants to do, there was a tariff trade deal put together with Canada and Mexico in his first term. And it expires in I think at the end of this year. Well, he's kind of like, hey, let's talk about this right now. So I just think the magnitude of some of this stuff is so complex that I think it's fertile ground for there to be some level of dispute taking place.
All right. Well, that probably brings us to the first chart, and I could have told Jim, you're going to bring me a chart that I could have just guessed here. I mean,
I know. Yeah.
Your first one, and that is basically. Let me go over here.
Jay, you mean you're not ready? Come on, man. You
No,
know.
it's for some reason I'm trying to share the screen, so we'll get to it right now. Here
All
we
right.
go. Sorry about that. All right, so
It's all right.
the first chart you have is economic policy uncertainty exploded after the election. I mean,
Yeah.
you had I'm going to use a Trumpism right here. You had sleepy Joe Biden for the last 4 years. Of course, no one was going to be surprised by anything, but here we are at the beginning of the year, and we're 1 week into the Trump presidency and economic policy uncertainty is on the rise. I mean, that makes sense, but what does that really tell us, Jim?
Well, what it tells us relative to what we've seen over the last few years, and there's been some events over the last few years. You can see the spike in 22. That was the invasion of Ukraine. The spike last year, well, in 23, that was the demise of three banks, Silicon Valley Bank and a couple of the other ones. And the spike in the middle of last year, it was August, in terms of Japan and the yen and all the rest of that stuff. But this just puts it in perspective to the magnitude of uncertainty. And I think it's going to drag on for a while because it's going to take some time for the trade negotiations to take place. People don't know how aggressive Trump is going to be regarding deportations. I think most people in America are supportive of, oh, you went through the court system. The court said, no, you have to be deported. And there's about 1.5 million of those people. Well, I don't think people object to that. You committed a crime. Well, you're going to get bounced. Oh, you're a member of one of these gangs that's doing some bad things. You're going to get bounced. I think most people are fine with that. Now it comes down to, do they start going after people who've been here 5, 10, 15 years that have been good citizens, productive, got a job? Uh, do they start going after those people? I think if that starts to happen, Blake, I don't think a lot of people will like that. You know, we want productive people into it. We need productive immigration to supplant the weak birth rate that we currently have for the last like 20 years or 15 years at least. So again, I just these issues are going to take a while to be resolved. There's going to be a lot of court stuff that's going to delay the resolution, and that's so it's stating the obvious to your point. At the same time, just because it's really uncertain. Well, it's not changing, and that just means that people are more susceptible to the latest or the newest headline.
All right. Well, the next chart you brought is about the beige book. Tell us what the boring brown book told us.
Well, it just reaffirmed what I think the messaging has been is that there's reasons why, like, okay, we cut rates in December, but we're in no rush to do anything more. But the thing that to me stands out is, again, the November meeting was November 7th, 2 days after the election. And of course, the December meeting well after. But the spikes you can see in terms of the number of times a reference or mention regarding trade and tariffs in the beige book, dwarfs anything we've seen in a very long time. And the same thing in terms of immigration and everything else related to that. So my point is, uh, these two issues are front and center for the majority of FOMC members. In other words, they think that there's a real risk that more inflation will come as a result of the trade negotiations and potentially wage inflation if Trump goes beyond just getting rid of all the bad people and starts going after people that are working, good people, they're working. And if he starts to do that, and all of a sudden the excess labor supply that we saw happen last year starts to dwindle, well, that leads to wage inflation. So my only point in bringing this up is, the Fed's concerned about the employment market. It's concerned about inflation, but it really is, in my view, almost hyper focused on the uncertainty that these two issues, the assumption that they're making is it means more inflation. And that's the next chart, which we've looked at previously. I'm just trying to tie this all together. This is the summary of economic projections from December. And what you can see versus September, the outlook for inflation was relatively sanguine. They didn't, 2.1 or whatever. Well, all of a sudden, to go from 2.1 on the PCE to 2.5 and on the core to jump by 0.3, just between, did anything that significant happen in terms of inflation? Were there supply bottlenecks or, oil shock or any? No, these are all anticipatory from the Fed's point of view that we think we're going to get more inflation. And these are significant numbers. So what does it mean? For me, it means until these folks have clarity regarding these issues and can then try to do some modeling in terms of, okay, what kind of impact are these things that we just learned about going to have? I think there's this bias that they're going to be sitting on their hands. So obviously no rate cut at the meeting on January 29th. I think the
Which
mid-March
is
meeting.
next week. The Fed's one
Yeah.
of three central banks that are meeting next week that I'm following anyway.
Yep, yep. So, and then obviously the conversation and speeches given afterwards will give us more direction. But I don't think there's any direction other than these are really important issues. We think they're going to cause more inflation, and therefore we're not going to do anything until we get a better handle on it. Again, will they have all the information they need by mid-March, which is the subsequent meeting? That would be amazing, if they did. So my only point is that this uncertainty is expressing itself through the inflation view of the FOMC members, and it's the risk from their perspective, based on the increase in these numbers, is significant.
So Jim, before we get into how you feel technically about the dollar, gold, S&P, TLT, I want to ask you about next week because Waller, who some people believe he is next in line to take Powell's
Hmm.
mantle, if you will.
Hmm.
He was just discussing that we could see further rate cuts. I
Yes.
mean, do you think that further rate cuts are in store for us? And because the market's obviously going to like that. The market
Yeah.
and even Trump said, I think yesterday when he was at the WEF
Right. Right.
or in Davos, he was via satellite talking about how maybe it wasn't there, but it was after that. He talked about how he thinks that the Fed should cut rates, and if Powell needs his advice, he's available, something like that. But well, I mean, he's obviously the Fed chair. Powell and probably soon to be Waller is probably going to feel some downside pressure or some pressure to cut rates. Do you think it's even possible or feasible?
Again, Waller is well respected, to your point, because over the last few years, as we went into the pandemic and so forth, some of the ideas that he put forward were relatively accurate, so that he's earned that respect inside the FOMC. In terms of Donald jawboning anything, again, from the FOMC's perspective, the last thing they want to do is appear like they're caving in to President Trump. And so that means that they're going to need to have, because if they do that, their credibility takes a big hit. And I don't think they want to do that. They've been working since they were so wrong about inflation being transitory, Blake. They've been working very hard to convince everyone we're serious about getting inflation down to 2%. And I think certainly Powell believes that. I think Waller does too. And the one thing I'll note is the interview that Waller did on CNBC, where he expressed the things that you just noted. I think at least three different times. Well, depending on how the data comes in, you know. So, as we've talked, the next 4 months we're likely to see the annual rate of inflation in both the CPI and the PCE come down a little bit. That's what they need to see. But I think they need to, more than anything, see the resolution in terms of what inflationary impact are tariffs going to have, and is President Trump going to deport so many workers that we have that issue. So I just think that, yes, the bias to lower rates, because, yeah, the majority of FOMC members still believe that the funds rate at 4 3/8 is restrictive relative to the neutral rate. They'll debate on how restrictive, but I think there's broad agreement that it is. So are they leaning toward rate cuts? Yes, for that very reason. But they're going to need justification, irrespective of Trump's comments. They will need in their minds, and I think the perception of how markets respond, justification for lowering it. Think about how much there's been, a fair amount of negative feedback. Wow, look at it. Now it looks like they cut too much too soon, you know. So, they hear that kind of stuff. Why did they do 50 basis point? They only should have done 25. So anyway, I would dismiss the stuff from Trump. If anything, that it probably increases the resolve
All right.
to
Well,
just follow the data, do what the data says, because that's where we want to get to. We want to get to where inflation is close to our 2% target, and anything that takes us away from that creates a bigger problem.
well,
So,
you've been talking recently about a move lower in the dollar, and it looks
mhm.
like it's starting to really take hold this week. People have been brushing off the threat of potential tariffs. They hear this February 1st, and I think the market's in that mode and has been all week, kind of prove it until proven otherwise. We're just gonna we don't really believe you. Then the comments from last night about Trump and China, the tariffs that we mentioned, that it's not something
Hmm.
he really wants to do. It's really weighing on the dollar. And then on top of that, the U.S. Services PMIs came in
Him and softer.
worse than expected. Still in expansionary territory today, but when you have Europe looks a little bit better, UK looks a little bit better, US not as good. You're starting to see the dollar exceptionalism story going. People start going, well, we've been exceptional for a while. You're starting to see the dollar come down. Now you have long since, and I've always, I sit here and scratch my head, and considering that I'm short the dollar, I'm anxious to hear your view. You've always thought that we're gonna have a significant drop below 90. Do you still believe
Below
that? And
95. Below
what's that?
95. Below 95.
Below
That's just,
95. Okay.
yeah. Yeah.
So tell us how you feel about the dollar here. And is this where
Well,
I'm going to go mortgage my house and start selling dollars and buying euros at this point? Is that what I do?
probably because the dollar index is 57.6% of the euro is 57.6% of the dollar index. So, again, all the things that you talked about as far as why people have been expecting the dollar to go up. What does that cause people to do in the real world? Well, they get long dollars. So at extremes, you get extreme positioning, whether it's negative the dollar or positive. And so
Yeah.
once you start to see some cracks, maybe it isn't quite so positive, that positioning starts to work against the dollar. People start lightening up. That's simple. So for me, last week we talked was, yeah, the framework. I'm looking for the dollar to decline. Getting below that rising blue trend line was step one, which happened on Monday, I believe. The 5 and 13 exponential moving averages where the red line crosses below the green, that happened. Also, you can see from that high at 110.17, 5 waves down, 1, 2, 3, 4, 5. So closing below 107.50 is kind of like the icing on the cake. The fact that we got 5 down, to me says, all right, you could get a bounce here. But ultimately, what's been unfolding over the last week to me validates the expectation that the dollar is going to have a deeper correction. And as I said, over the next 12 months, I think below 95. Now, where am I getting that number? Well, the dollar dropped from 114.70 something to 100. So about 15, I think it was 15.2 points. Well, you
Yeah.
take 15 from 110, it gets you right around 95-ish.
Somewhere down
So
here.
that's
Yeah.
where that is coming from, is you had a 15-point decline. Then we had a big A, B, C, which I think completed last 2 weeks ago. And now we're beginning a bigger wave C to the downside from the high in October of 22 at 114.70. So that's the bigger picture. And I think we're at the very onset of that larger decline. It's going to, take time. But I think over the next year, in all likelihood, that's what's going to unfold.
Well, the Trump administration has been pretty vocal in wanting a weaker dollar, and they feel that this is how they're going to be able to bolster their manufacturing base. Our manufacturing base here in the
Right.
U.S. is with a weaker dollar. So how they manage to do that is to be seen. But great view and great look, Jim.
Yeah. Well,
Um,
the other thing too about tariffs, Blake, just real quickly is, if trade talks don't go quite as well and it looks like tariffs, again, I'm not in favor of tariffs. I understand the idea of negotiating and all the rest of that stuff, but conceptually, uh, free trade over the last 70 years has been a benefit for the whole world in terms of lifting people out of poverty around the world and so forth. And over the last 10 years, free trade has kind of stagnated in terms of its growth. And so for me, going back, when was the last time we had real trade issues? Well, it was the 1930s. So uh, those are some of the reasons why I think tariffs are a dangerous ground. And if the trade talks don't go, perfectly smoothly, and there is some back and forth and concern about a trade war, I think at some point in time, think, I'm not sure that's going to be good for the U.S. economy you know.
yeah.
So anyway, just how perception starts to change. And so, the idea that the dollar was topping was based on some of that, but also the price pattern suggested a high was being created over the last few weeks. It took longer than I expected. I thought we'd get above 108.54. I did not think it would have gotten all the way above, 110 even. But, that's kind of the way it's unfolded. But I have, never in the last 3, 4 weeks anything had changed the longer term outlook. And now what we've seen, excuse me, is, reinforcement of that.
All right. Well, the next chart you brought is gold. You
Yeah.
had been kind of hesitant on thinking we go to all-time highs and hit a new high, and we're getting real close.
Yep.
Has your
Yep.
view changed? Are you still kind of hesitant here, or are we heading
Yeah,
to
I am. I
3,000?
mean, and again, hey, I talked about last week how we could get above that red trend line, around the 2720-ish range. It went a little bit further, but what I talked about last week was the concept of a B wave. So the decline from 2789 to 2541 was wave A, and you can see how choppy the rebound has been. So for me, it has the hallmarks of being a corrective wave, um, relative to what took place before. And so for me, in this, hey, we're at the moment of truth, maybe. I still think this is a B wave. That implies there will be a decline below 2541 for wave C to complete the wave four correction. All right, so from the low in September of 22, wave one up, there was a wave two. I think wave three ended at 2789. So if we look at, the gold went from 1812 to 2789, it's 977 bucks, a 382 retracement. It again gives a target that's comfortably below the 2541. So B waves more often than not don't take out the high of wave three or the prior wave. This is then termed an irregular B wave, if it indeed it gets above 2789. But it doesn't then automatically negate the idea that, all right, you make a top and then you go down. Again, positioning and sentiment are really pretty optimistic. So,
Well,
um,
I think we could both agree that nothing about this market is regular, so it might be irregular. So, kind of, I was going to say something else, but I'm not going to say.
yeah, I know.
Uh,
I had an idea too, and I said, no,
you
Jim,
thought it
don't
was
go
going
there.
to come out of my mouth, didn't you, Jim? All right.
Well, it went into my head and you didn't even say anything.
All right, let's talk about the
All right.
S&P here because the S&P is almost at all-time highs. I mean, well, we are at
Yeah.
all-time highs. What am I talking about?
Yeah. 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 Yeah.
We're
Yeah.
at all-time highs. Are we going to 3,000 now, or excuse me, 7,000 now? I mean,
You
what's
just can't go get gold off your mind.
yeah,
Um,
right.
yeah. No, last week when we talked, I went through, okay, you had an ABC decline in the S&P, and then there were five waves up from that low at 57.73. And that to me said, this is going to a new all-time high. I didn't expect it to go directly to a new all-time high. I thought we'd have a pullback and then up. But here we are.
You
So
have to be fluid with this news flow, right?
you do. And, again, Trump not enacting the tariffs right away was deemed constructive. Waller's comments were deemed, oh my goodness, maybe rate cuts are still going to happen. So a lot of things came together to help that. But the point is the lower panel is the New York Stock Exchange advanced decline line. And it's a simple idea. If the majority of stocks are going up as the S&P is going up, well, then you've got a pretty strong trend. When the AD line diverges, in other words, the S&P makes a higher high, which it has just done, and the AD line does not make a higher high, it's a warning that, hey, folks, underneath the surface, there's a level of weakness and deterioration that should there be a reason to sell, the market is more likely to fall more than if the advanced decline in agreed and made a new all-time high. So this is a warning. So for me, looking at the price pattern of the S&P, is this rally from 57.73 to today's high, wave one of five, and all we're going to do is get a little pullback to retrace, a 382 or 50% of the rally before we get another leg up? Or is this it? Is this thing's over? That this is all a wave five? Yes. You doing some
I'd
calisthenics?
like to ask a question. So, isn't this just an example, or just a product of the Mag Seven resurgence? You got Netflix. You got a lot of companies, a lot of tech companies next week in the Mag Seven that are actually reporting earnings.
Yeah, yeah. No, earnings overall have been good and fairly consistent across various sectors. In part because hey, in the fourth quarter, the GDP grew probably 2.5%. That's a decent level of growth that will benefit most companies. So you're right. The Mag 7, we did get bounces in some of the small cap, mid cap sectors. So some cyclical stocks, which from that high in November to the low last week had really gotten beaten up. I mean, you look at industrials, basic materials, and some of these other things, Blake, they went through they went down more than the S&P. And so you got this snapback rally in some of those sectors, which was helpful. So even though the Mag 7 across the board haven't made new highs, the combination is what's helped the S&P to get here. The financials have been probably the biggest contributor because you had some bank earnings out last week that were very strong.
Yeah.
And, the financials are, I think, the second or third largest weighting in the S&P. So again, just for people who maybe aren't familiar, historically, going back to like 1928, when the AD line doesn't convert or agree or confirm a new high in the S&P, it either sets you up for a 5 to 10% correction. In other words, the overall economic environment is okay, so you get a pullback, but it's like there's no serious reason to be a seller. Conversely, every major bear market has been preceded by this condition. And then subsequently, what happens is, oh, you get a really good reason to sell. More often than not, it's been the onset of a recession and so forth. So my point is, again, this is a warning. At a minimum for me, if this is wave one of five that we've just are in the process of completing, it just says, okay, you can get a wave two pullback, maybe down to 6,000, maybe 5,950 or something like that. And then there's going to be another surge to a higher high. If the pullback is three waves, like the last one was, well, that'll indicate, okay, folks, we're going to have another, strong move to the upside. And the targets would probably be somewhere 62 to 6,300 or so. So the nature of this pullback that I think we're on the cusp of, if it's an ABC, then time to load up for another move up. Just like last week when we talked and the week before, ABC down, the equality missed by, I think, 5 points or
Yeah.
9 points on the S&P. So it's like watching this stuff one step, on the way. I just think, if we're going to have a wave two correction, some of the news regarding tariffs in the early part if not on February 1st, early part of February, provides a reason to sell,
Yeah.
not a big one, but a reason to lighten up.
Right. Okay. Well, Jim, I want to thank you for bringing all the charts this week and always keeping us, abreast of everything that's happening and the economic data that's happening. So tell the traders at home how they can get to your work and
Yeah,
maybe even get a discount.
macrotides.com and or send me an email, jimwelshmacro@gmail. And if you want to become a subscriber and you say, yeah, I saw you and Blake talk and all that, and you'll get a nice discount.
All right. Well, there we go. Well, Jim, I want to say happy Friday. I'm looking forward to this. This week has been at least, it felt like 3 weeks long. So next week I have
I'm
a
going to
feeling
say to you, Blake, happy weekend.
yes, happy weekend indeed. All right. Well, Jim, thank you so much for joining us as always. And for those of you that are, or if you're new here and just watching this video, this is exclusive content at Trader Summit. So make sure you click down below, subscribe. It's free to subscribe to this channel. It's free to give Jim a thumbs up, and it's free to jump down in the comments and say, I agree or disagree with what you're saying, Jim. So, and Jim
I like feedback, and as you know, I do respond to anybody who poses a question or whatever. I'm happy to respond.
yeah, and matter of fact, last week he said you guys are kind of lacking in comments, and he thought it was something wrong. But no, I think everybody's just intently watching your views and listening to them. But yeah, if you have something that you want to add, or you think you could add a value, or maybe have a little bit of a debate with Jim, jump down in those comments down below and get to it. All right, Jim, thank you so much. I'll see you next. I'll see you next Friday. Just wanted to make sure. Yeah, I'll see you next Friday.
Blake, come in, Blake.
Yeah, I just wanted to make sure I'm going to be here next Friday. All right, Jim. Have a great one, and thank you everybody for listening in.
Stay well.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.